Enbridge is a midstream player providing a lot of the infrastructure to move crude oil, natural gas from where it's being extracted over to where it's needed to be refined. It's a $109 billion market cap company with a PE in the current year of 23.7, forward P of 22. It pays a nice dividend of 5.39. Over the 1 year, it looks really good, up 22%. Over the 5 year, up 69%. Not quite as good as other energy players in this space, but this would be a more stable company. When we look at other factors in the stock, the business is growing nicely. Again, they're not subject to the commodity price because they're just moving the commodity itself and they're charging to do so, the transmission lines. Now, when we look at free cash flow, they have grown, but then contracted the free cash flow a bit. The gross margins have gone up and down, but now they've been coming down a bit, down to 41%, and profit margins are 9.65. Taking a look at other factors weighing on this business, let's take a look at the balance sheet. And here, this business has less than $1 billion of cash, but they have $74 billion of debt. That's a lot of debt. And the debt to EBITDA is 6. That's a lot of debt. And these transmission lines do cost a lot of money. But again, I'm going to keep repeating it. A lot of debt means a lot of risk. And that is well above my maximum, which is 3 of EBITDA to debt. So that is kind of a showstopper for me on this stock. Now, analysts using just earnings per share think the stock price is discounted any way you look at it. And in fact, on average, they believe it's discounted by 22%. When we look at the top line growth, that looks fine. It's flat. And the profit's going to grow on the bottom line. But again, I keep coming back to that debt level. The reason I check the balance sheet on these companies is I don't want to buy a business. It's just really hampered by excessive debt. And that's what we're dealing with here. I completed a valuation on Enbridge, and it's not a pretty picture. That debt's showing up again. I do get a good intrinsic value of their free cash flow. But what I like to do is I add cash and then I take away debt. And when I do that, it really drops the equity value. There's very little value left. Most of the company is owed to whoever owns their debt. Therefore, it's actually a pretty drastic premium that an investor would pay for a business that's so indebted. On the earnings per share, it's not as bad, but it's still not positive. So overall, this is a business that's priced 68% too high. Now, I may be off by a little bit, but you get the picture. That debt is just bad news. This is not an investable business for me.